Basically, it seems like high growth software stocks are kind of getting bombed out right now. A number of them have hit their 52-week lows. If you look on the 52-week low list, just look that up on Google, you're going to see a ton of software stocks. And so I'm going to go through some of these and just talk through some of the ones that have all hit their 52-week lows in the probably basically like the last week. And let's see if any of them seem attractive. So I'll kick things off with Snowflake. They're the first one here. I'm doing this in order of largest market cap to smallest market cap.
And I'll share the screen for video listeners on, I believe we do it on Spotify too, but you should be able to see some of this stuff on the screen share.
Yeah, and so Snowflake, they help get rid of data silos. It's a data warehousing platform, and it's really done a good job growing with kind of the cloud market overall. So their 5-year revenue CAGR, or the annual growth rate for their 5-year revenue, 96%. It's down 66% from its highs, and it's got a market cap of $46 billion. The sentiment on this one seems horrible. Everyone seems to think that this is like kind of fading away, I guess, or maybe people are just taking victory laps because it used to be one of the most expensive stocks around. Honestly, I don't know the market for Snowflake very well, but it's still a fairly demanding multiple. It's not like cheap in the traditional sense.
Look at it. Look at this. I mean, you see
Sure.
that's operating income. It just keeps moving in the wrong direction.
They do have plenty of cash to burn, which
great. Let's just be unprofitable then.
I mean,
what's that price to sales?
It doesn't make sense. If they have the money to invest, I don't see why they would. If they think they're generating a good return out of their investments that they're deploying, it makes sense for them to do it, right?
Sort of, but I think most good businesses are all usually profitable once they hit. I'm sure this is a considerable size. I mean, if you're that good of a business, I don't really see why you can't be profitable at this scale. And if you're not, well, okay, what are those operating expenses that are keeping you growing? But if they keep growing this fast, I mean, here's what's crazy, Ryan. Look, remember Snowflake? Price to sales 120 when it came public. I guess now it's down to 15, but that's some multiple compression right there. Maybe the opportunity's there because everyone's gotten washed out. I don't know.
How much cash does it have?
Let me check. Sometimes it's tough to find that since the definitions here. Total cash and short-term investments, $3.5 billion. I'm guessing they do a lot of SBC, so the actual cash flow is not that bad. So that's not the concern here. I bet the concern is share dilution, which, let's check her out. Total shares outstanding. Growing at about 4% a year. Yeah. That's a headwind. That's a headwind right there.
But 96% revenue growth. Now, I don't like situations where we just say, but look at the revenue growth. But 4% dilution and 96% revenue growth, the revenue growth per share is still quite strong. And in theory, if they can get to a reasonable operating margin, it seems like they're probably going to. It's hard to imagine them not working out if they start to see some operating leverage. The second one I'm going to talk about, though, it's Atlassian. This is Australian-based company here. They are a project management software system. They're most famous for Jira. It's not something I've worked with before, but it helps connect technical and business teams so that they can plan and track and manage everything together. 36.5% annual revenue growth for the last 10 years. Pretty staggering. Drawdown, it's down 65% from its highs. It's got a $42 billion market cap. What do you think about this one, Brett?
Let's see. I'm looking at operating income. If I look at all these, Ryan, and they don't generate any earnings, I'm going to be mad. Because what are we doing with the software companies? But I know Dropbox actually generates a profit. I was going to look at I'm assuming they have high gross margins. I know we're using price to sales and that's a crime, but I like to, if I know the gross margins are high and they're not profitable, I think it's a decent proxy. We're at a price to sales of about 10. I mean, what was that growth rate again on revenue? How fast are we growing?
37% over the last decade annually.
Okay, well, what about recently?
You got it right there in front of you.
Yeah,
Let's see here.
Let's see, since June 2021, 32%, pretty good. Yeah.
Here's the thing about, I think you might be looking at some of these wrong, to be honest. We're going to get into some of these human capital management software where it's hard to distinguish between one another. But with businesses like Atlassian and Snowflake, they've built a product and a business that is durable. Like, it matters to customers, it seems. Now, I'm not in the nitty gritty. I don't really understand the customer value prop that much, but from everything I've read, it seems like the customers love this product. These are the ones where if they find religion, or if an activist CEO comes in, or you get, or not an activist CEO, activist brings a CEO in, or an activist just joins the board, whatever, and you get a Salesforce-like situation, I think you can start to see serious operating leverage in these businesses, and you're probably going to get really strong returns.
Possible. But let's say, okay, you're at a price of sales of 10. Let's say they can get to best of the best operating margins of 40%. What are we at? A PE of 25? I mean, yeah, that can work if the growth rate continues, right? But I'm betting on Microsoft level margins. I don't know if that's a bet I want to make at a price of sales of 10. Now, if it's down to 4 or 5, I mean, I think that's a different story. But someone like Snowflake or Atlassian, these valuations don't really attract me, especially because it's not a sector I have any sort of circle of competence on.
Okay, let's move to the third one here. Veeva Systems. Veeva is a leader in cloud-based software for the global life sciences industry. I remember hearing basically a description on the details of the business, and essentially it sounds like this really kind of powers a lot of the pharmaceutical companies. And I'm not 100% sure what the competition looks like in that space, so I'm not going to talk too much about it, but really strong growth rate over the last 10 years, 30% annual revenue growth, $28 billion market cap. It's down just under 50% from its highs. You can go through some more of the numbers here. I remember they came public, I want to say in like 2015 or 2016. Could be wrong there. But
Ryan, they're growing revenue at 30%. For anyone that had the share screen there, and guess what? They're actually generating positive operating earnings. This one, yeah, they went public a while ago. They've been public for at least 10 years, I think. And I believe, yeah, I don't know this company that well, but I believe it's like Salesforce, but for specifically biotech. And that could be a little bit different. I think someone described it as something of biotech. So it's one of those software platforms, but specifically for that industry, maybe pharmaceuticals as well, which makes sense given that's a niche that has a lot of interesting things that you want. That's particular to that one. Let's look at price to sales. Hey, whoa, okay, 11.8, not terrible for a company that's this profitable, growing that quickly. Yeah, this one I mean, given the fact that they're able to grow more efficiently than Atlassian or Snowflake, I'm more attracted to this one. And because they're in a niche, I wonder if they can have some sort of a better competitive advantage where these broad-based platforms there's another competitor that comes out every month out of Silicon Valley.
yeah, it excites me. I worry that maybe this is closer to the maturity than some of the other businesses. Maybe there's ways to upsell, but being that they are so niche, and if you look at the customer count on the segments and KPIs, I imagine it's
I'm not
maybe
sure
tapered off a little bit.
Do they?
They don't do the customer count. Bummer.
They don't do customer count. But Ryan, let me ask you a question. Do you think biotech and pharmaceuticals will be a larger industry in 10 years or a smaller industry? I'd say almost definitely larger.
Yeah, definitely larger. Okay, let's move to the fourth one here, MongoDB. This is one that you actually pitched to me, I want to say like 4 years ago. And
Yeah.
for the life of me, I just could not grasp the business. But basically, here's the headline: MongoDB provides a document database, which makes it easy for developers to store structured or unstructured data. They have grown revenue at 50% a year over the last 9 years, $17 billion market cap. It's down 60% from its highs, and it dropped significantly. It dropped quite far after its latest earnings report. So some cause for concern here on the latest report. I remember growth's kind of flatlining a bit. It sounds like maybe there's a little more competition coming in.
Yeah. That could be tough. Obviously. Yeah.
What's
It seems
the
like
operating earnings look like?
yeah, let me pull that one. I did want to, I guess, before I change this one, look at so they have their MongoDB Atlas, which basically was a new product back in 2016 or something around there. And it's their cloud-based solution for their typical database. It's supposed to be superior to something like Oracle, but I don't know the nitty-gritty details of why. But it basically went from zero to $1 billion in revenue in, what is it, 1, 2, 3, 4, 5, 6, 7 years, which not bad. But yeah, let me pull up that operating earnings. Let's see if they're profitable. I'm guessing no. Yeah, this one's ugly like Snowflake. I'm sure it's all SBC and stuff like that. I'm sure they're generating positive free cash flow and they brag about that. But let me pull up maybe. Why don't we just use price to gross profit? That's better. Price to gross profit of 13. That's not terrible if you believe growth can reaccelerate. But if you said that, like, here's the thing about these. If I'm looking at a software company like this, I have no idea why revenue's slowing down. And if you don't have any idea why revenue's slowing down, you can't make any sort of estimates about the future, which would concern me for a lot of these.
Yeah, the other thing is price to gross profit of 13. Most of their costs are operating expenses. It's, I would assume. So
Yeah.
it's not even, I think gross profit is very misleading relative to what they could eventually earn. It's nice that they have high gross margins, but it requires a lot of research and development, a lot of developer talent, which is costly. So I'm going to say on this one. We've gotten through 4 here, and I think Veeva Systems is probably the most attractive so far. The 5th one here is Paycom. Now, this is one I'm a little more familiar with. They're a human capital management software provider primarily for small and medium-sized businesses. They help with talent acquisition as well as time and labor management, among other functions. So basically helping run the workforce, helping attract new employees or keep track of new talent as you're acquiring them. I think there's some to like here. Paycom's been around for quite a while. 31% revenue growth over the last 10 years annually.
Yep.
$8 billion market cap, down 73% from its highs.
Wow. All right. Yeah, I'm seeing this one again. I think listeners won't be shocked to see that I'm seeing positive operating earnings, and that actually makes me way more excited about the company. I mean, seriously, like think about these software companies with these supposedly high margins that they like. If you can't generate positive operating earnings at a $3 billion revenue level, like when are you going to do that? I just, okay. Sorry, little rant there, but let's go look at this valuation. Price to sales 4.7. This one's attractive. I remember looking at them. I believe we did a show on them a while back. Wow. In 2021, that price of sales got up to 30. I mean, software was crazy. Ryan, do you remember? Like, people were getting 10 baggers left and right. The multiple expansion was crazy. And it seemed like didn't it seem like one of those situations where were you worried that, like, I felt like this too, like, am I missing something when that multiple expansion just went crazy a couple years back?
Yeah, I started to think software was like these unbreakable models, which just is not. What's the EV to EBIT on this?
Yeah, I was going to say we can actually use a real earnings ratio here. It looks like 13.5. Wow. I saw some people tweeting about it too, like some kind of value focused people. 13.5. That's not bad.
This
That's
takes
not
the
bad.
cake for me so far on
I want to know
most
why.
attractive.
Why is it down so much? What's happening? Because for a company that chart looks so good, the revenue growth looks so good, the operating earnings look so good. Um, Why is the EV to EBIT 13.5? Because I think people are they must be expecting that not to continue. Why? What did they say? What happened? That would be my next question. Obviously, we can't talk about it now, but hey, Brian, maybe that's the next one you look at for the old podcast here.
Yeah, I could be down to research that one. Sixth one here is Paylocity. We had someone come on and pitch this beforehand, on our show before. Andrew Marshall, he came on, pitched Paylocity. I talked to him. He's actually since sold, but Paylocity offers payroll and tax services to simplify, automate, and manage compliance requirements as well. So basically, it's payroll software provider, and they earn some extra interest income because they hold on to funds for a little bit, which this stock is down 54% from its highs. It has had remarkable revenue growth over the last 10 years, 30%.
Profitable now. Profitable. Yeah.
I think they're earning a lot from that interest income. And
right.
Look, maybe interest rates could go up from here. It's possible. It doesn't seem like that's what's being telegraphed right now by the Fed. But if rates do come down, it certainly hurts them. Interest income is ultra high margin. It doesn't really cost anything. And so it really helps profitability. The issue is that I'm seeing a lot of these companies do this now. Bill.com is similar, where yes, you are earning interest on their funds. People didn't care about that for a while, but now customers are starting to care because they're starting to look at this and say, okay, they're holding my funds when, they're generating interest on it, but I'm getting sick and tired of having these funds held in limbo. I'm going to try to find a solution that doesn't do that. And there are certain solutions to kind of circumvent some of these payroll and billing solutions. And I'm seeing that more and more. People try to get around Paylocity, get around Bill.com, find a cheaper solution. So that would be what I'm a little bit concerned about here. How much is core revenue growing as opposed to interest revenue?
All right, we can pull that up. They do have that for us. Operating revenues. Let's just do quarterly to see recent. Okay, loading. Since June 2021, operating revenues are growing at a 33% annual clip. Doesn't seem like there's been much of a slowdown recently, but I'm sure guidance must have been weak, something like that.
I heard
PE is pretty
they
high though. PE
missed their
41.
guidance, but
yeah, PE 41, EV to sales 5.5, EV to EBITDA 27. Not super cheap either.
all right. I'd say meh on that. Let's move to the seventh one here, Dayforce. This is a company I really had not heard of prior to.
Ticker? What's the ticker? I haven't heard of it either.
DAY.
Dayforce, huh? Haven't heard of this one. Wow.
They also provide HR, payroll, workforce management software, as well as talent management functionality. I'm starting to realize that this is a bit of a crapshoot. It seems like it's a bit of a commodity.
There's a lot of software stocks. Yeah.
Now, it hasn't grown quite as fast. 9-year revenue CAGR is 12%. It's down 62% from its highs, and it's a market cap of $7.8 billion. It looks like they had a huge drop during COVID in revenue.
Yeah, I wonder if you're seeing the share screen here. I wonder if they sold a segment, because let me look at just if we go from June 2020. I know that might be a bad comp here and a little bit of a chart crime, but from June 2020 to today, revenue has grown at 24% rate. That's not bad. Let's look at see. Is it profitable? That's just a question every software investor should be asking. Is the company I'm investing in profitable? And they are. Positive operating earnings doesn't seem like much.
What's the trailing? 12 months.
That's quarterly. Oh yeah, that's why it doesn't seem like much. Trailing 133 million and market cap of 8 billion. Okay, not that great. All right.
I'm probably going to pass on this.
Look at the sales ratio.
I don't need to go much further.
Of 5.
Just I'm going to pass.
Here's a tip that I've gotten heard on in the past, and I make sure to look at, because it's helped me like with stuff like Peloton. Look at the definition of operating expenses. Like a lot of stuff, it's not the same for every company. A lot of companies where you go, well, gross margins are 80%. Why do they have negative 20% operating margins? Maybe it's because they're putting a lot of their cost of goods sold within operating expenses. So just look at that definition. It's in all the annual reports. Okay.
Let's move on to the next one here. A company we're familiar with, Dropbox. I think a lot of people are probably familiar with this, compete with Google Drive. It's a file sharing, content collaboration platform. It's actually gotten better at helping teams kind of work together on projects or projects, documents, presentations, stuff like that, and then sharing out of it as well with their acquisition of, I can't remember what it was called. They acquired some company.
Or no, DocSend.
DocSend, that's right. However, growth has stagnated a little bit, and frankly, it's kind of flat over the last couple quarters. So a little bit concerning. Generates a lot of cash, has some stock-based comp, though, that's worth kind of taking a look at. They did do a big price hike, which maybe is leading to some of the attrition in paying customers. They have $440 million in last 12 month operating income. The market cap is, what did you say, around $8 billion right now?
7.2.
7.2. So EV to operating income of what, mid-teens?
Yeah, and let me look at total shares outstanding. From June 2021, it's declined at a 6% rate. So not bad. That's not bad. That can help. It's just,
I'll be honest, I was happy when we exited this position.
yeah, we have owned this in the past. It's just tough. They haven't executed that well. They seem to be flailing a little bit with new products. Yes, the the capital returns program is smart. They have good cash conversion, all that good stuff. They're reducing shares outstanding by a good amount, but where do new customers come from besides acquisitions? I don't know. It's a little bit messy. Probably works from here because the stock is so cheap, but is it a high quality business? No.
I'm more interested at probably 10 times EBIT.
All right. Yeah.
Which it's a
just
little
given
bit of
the
ways
buyback.
From. Yeah, I mean, if we're expecting low to mid-single digit growth, margins maybe trend a little bit up. The buyback is there, but when they really reduced share count, they took on some debt to do it initially. So I wonder how much they can really fund to the buyback. They'd probably take down shares, I'm guessing, by like mid to high single digits on a going forward basis.
Let's take a cash and equivalents. Yeah, I mean, it's come down a little bit, about $1 billion in cash left. And liabilities, total long-term debt, a little higher. So yeah, definitely. About net cash of zero from what it looks like.
Yeah. I'm not interested in Dropbox at this price, just honestly. Let's go Workiva. That is the
WORKI. Workiva.
Yep,
I got it.
They say Workiva is a fit-for-purpose connected reporting and compliance platform. Basically, I think that just means they help customers individually. It's not like it's a purpose-built solution and not just one out-of-the-box platform where everyone can use it in the same way. 10-year revenue growth, 21% annually, $4.2 billion market cap, down 53% from its highs. Is this bad boy profitable?
I'm going to check. No. But getting better. The visualization helps here. They're moving in the right direction, but still, why aren't you profitable at such a large scale? Price to sales 6.3, not crazy. Yeah, this can work if you believe, or if there's some part of the story here where you think they're going to inflect to profitability and quickly. And remember, it's not just, we have a 5% margin. It's we're going to hit 20, 30% margins, which all the software companies seem to talk about and never actually do. So my guess would be they don't do it because it seems like what is it called? The base rate on these software companies is they love talking about their margin inflection that doesn't show up except in adjusted EBITDA numbers.
Yeah, I'm probably gonna pass on this one here. Last one. Let's go. Epam Systems. Now, full disclosure, this is not a software stock per se. It's more just like software consulting. They have a whole bunch of employees in. Actually, a lot of their employees were in Ukraine, and this was a business that grew revenue really quickly. It was a talented tech workforce that was lower cost than what you would get in America. And if you look out over the last 10 years, it's become just a much, much bigger business. The issue is that their workforce was in Ukraine.
Yeah. So the war.
Yeah.
Tough.
So it's really affected this business. They relocated a lot of them, but I just wouldn't be surprised if a lot of the projects are being delayed. People are afraid to work with them because the employees are busy, concerned.
Right. Yeah. Yeah. The looks like here them profitable every year since 2014. Enterprise value it says here is 8.2 billion. I wonder that's a lot lower than the market cap. So I wonder if they have a heavy cash position here. If you look at the last 12 months earnings, 575 million. So not too expensive on an EV to operating earnings, and their peak was in the fiscal year 2022 at 713 million. So if you believe that they can get back to that 713 million and keep growing it, well, they could be well on their way to $1 billion in earnings with $8 billion EV. I wonder how they've been on returning capital to shareholders. Maybe they've been hesitant, but yeah, shares outstanding haven't really been moving in the right direction. Actually, the wrong direction. So it could work if you believe there's a change coming here and they're going to get past this. But yeah, like Ryan mentioned, if they got all their assets in Ukraine, that's a tough one.
Yeah. That's all 10. What would be the most attractive to you?
Let me go through the list here.
There's Snowflake, Atlassian,
Paycom,
Veeva. Okay.
and Veeva.
Yeah, I'd say Paycom's probably number one for me right now. Gonna do some more work on that after this chat. Now, before we move on.